You're standing in the checkout line at Home Depot on a Saturday morning, and the guy in front of you just dropped $847 on supplies. You peek at his cart. It's caulk, drywall tape, some kind of pipe fitting, and what looks like industrial strength mold remover. He looks exhausted. His hands are covered in paint, and you think to yourself, that's gonna be me next year, isn't it? Because you just bought a house 3 months ago, and the seller swore everything was in perfect condition. They lied. Americans collectively spent $526 billion on home repairs and renovations last year. That's more than the entire GDP of Sweden, and yet, when you're sitting at the closing table signing papers on your first house, nobody mentions this number. They tell you about the mortgage payment, they tell you about the interest rate, they even tell you about closing costs, but the financial avalanche that starts the moment you get the keys, radio silence. Here's what actually happens. You buy a $350,000 house. Your mortgage is $2,100 a month. You did the math. You can afford it. Congratulations, you're a homeowner. 6 weeks later, the air conditioning dies during a heat wave. That's $7,000. 3 months after that, you notice water staining on the ceiling, roof leak, another $4,500. Then the water heater starts making a sound like a dying whale. $1,800. It's November now. Yeah. You've owned the house for 8 months, and you've already spent $13,300 on repairs you never saw coming. Your emergency fund is obliterated, your credit card balance is climbing, and you're starting to understand why your neighbor looks so tired all the time. This isn't bad luck. According to Bankrate's 2025 study, the average single-family homeowner spends $21,400 per year on hidden costs. That's $1,783 a month on top of your mortgage payment, insurance, maintenance, property taxes, HOA fees if you're really unlucky. These aren't optional expenses. These aren't lifestyle choices. These are mandatory payments for the privilege of owning a structure that is actively trying to fall apart. The real estate industrial complex has sold you a fairy tale. They told you that your mortgage payment is the cost of homeownership, but your mortgage payment is just the entry fee to a very expensive casino where the house always wins and the house is literally your house. Let me show you how deep this goes. Financial experts love throwing around the 1% rule. Set aside 1% of your home's value each year for maintenance. Sounds reasonable, right? For that $350,000 house, that's $3,500 a year. You can handle that. Except here's what nobody mentions. That rule was created decades ago when labor was cheap and materials were affordable. In 2025, that rule is catastrophically outdated. A recent Angie survey found that actual homeowner spending averages between 2 and 3% annually. That same $350,000 house, you're really looking at $7,000 to $10,500 per year just for maintenance, and that's assuming nothing major breaks. One homeowner reported budgeting $4,800 per year based on the 1% rule. Their actual spending? $15,000 every single year. The 1% rule isn't financial advice. It's a comforting lie that keeps you signing mortgage documents. But wait, because it gets worse, that maintenance number doesn't include emergencies. Nearly half of homeowners, 46%, faced more than $5,000 in unexpected repair costs last year. Unexpected, as in you can't budget for them because you don't know they're coming. Foundation issues can run $30,000, HVAC replacement up to $15,000, roof replacement averages $8,400, and if you live in an area with labor shortages, good luck getting that number. A NerdWallet study found that 44% of homeowners had their first major surprise repair within the first year. 12% got hit in the first month. You haven't even finished unpacking and your house is already extracting tribute. The psychological weight of this is crushing. Over 60% of homeowners report being more worried about covering maintenance costs now than they were just a few months ago. Think about that. These aren't people who bought homes they couldn't afford. These are people who did everything right. They saved for a down payment. They got pre-approved, they bought within their budget, and they're still drowning. Because here's the thing about houses. They're not like cars where you can just drive them into the ground and sell them for scrap. Houses require constant feeding. Like your roof has a lifespan, your HVAC system has a lifespan, your water heater, your windows, your siding, your foundation, everything is slowly deteriorating on different timelines. And when those timelines converge, you're looking at 5-figure repair bills that hit simultaneously, and the costs are accelerating. Home maintenance expenses have increased across virtually every category in the past year. 7 categories saw double-digit increases from Q1 2024 to Q1 2025. Supply chain disruptions drove up material costs. Extreme weather events increased repair frequency. Labor shortages made contractors more expensive. Interest rates on home equity loans made borrowing for repairs more painful. It's a perfect storm of financial pressure, and your house is sitting right in the middle of it. Location makes this nightmare even more unpredictable. Hidden homeownership costs in Hawaii average $34,573 per year. In West Virginia, $12,579. The exact same theoretical house maintenance, the same insurance needs, the same property tax obligations, but the cost varies by nearly 3 times depending on your zip code. New York City homeowners pay $24,381 annually in hidden costs. San Francisco pays $22,781. Boston pays $21,320. These numbers aren't anomalies. They're the new normal in major metro areas. The American Home Shield survey found that while 87% of homeowners experienced a home issue requiring professional help last year, over 33% couldn't afford to fix problems over $1,000. 15% couldn't cover repairs over $500. Read that again. 15% of homeowners, people who qualified for mortgages and passed credit checks, don't have $500 for emergency repairs. They're not broke because they're irresponsible. They're broke because homeownership is systematically more expensive than anyone admits. And we haven't even talked about insurance yet, or property taxes, or HOA fees that are rising faster than inflation, or the special assessments that can drop a $20,000 bill in your lap with 30 days notice. The maintenance costs are just the foundation. The real financial apocalypse is what's stacked on top. But before we go there, you need to understand something crucial about how these costs actually compound. Because maintenance isn't the only bill bleeding you dry. Property taxes are about to compound this nightmare in ways that'll make those repair costs look merciful. Let's talk about the tax that never stops growing. The average US homeowner now pays around $3,500 annually in property taxes. That's up 4.2% from last year, which means you're spending $291 every single month just on taxes before you even think about insurance or HOA fees. And here's the part that should terrify you. Property taxes aren't static. They rise with your home's assessed value, which means as housing prices climb, your tax bill climbs with them. You didn't sell the house. You didn't make any money, but the government decided your home is worth more on paper, so now you owe them more cash every year, forever. The geographic lottery here is insane. Property taxes vary up to 6 times between states. A $400,000 home in New Jersey costs $8,920 per year in taxes. That same home in Florida, $3,280. That's a $470 monthly difference for the exact same asset. And it gets worse when you realize how this affects your buying power. Lenders calculate affordability after adding taxes and insurance. High tax counties reduce your buying power by 10 to 20% on average. So that pre-approval letter for $450,000 in low tax Florida In New Jersey, you'd only qualify for $390,000. You're being punished for geography before you even move in. Non-mortgage costs, insurance, utilities, and property taxes jumped 30% in 2025 alone. Not over 5 years, not gradually, 30% in 1 year, and they're expected to keep rising. The combination of increasing property values and rising mill rates creates a double impact. Even if you never planned to sell, even if you're staying put forever, your tax bill is climbing on 2 separate escalators simultaneously. Now let's add HOA fees to this financial bonfire. About 44% of all for sale listings in 2025 were for properties in a homeowners association. That share has doubled since 2010. The median monthly HOA fee has risen from $108 in 2019 to $135 in 2025. That's a 25% increase in 6 years, but medians hide the real story. In disaster-prone markets, HOA fees have exploded. Tampa saw fees rise more than 17% in just 1 year. Orlando, Fort Lauderdale, and West Palm Beach all posted double-digit increases. Fort Worth jumped 14.6%. Sacramento, 13.1%. Atlanta, 12.2%. These aren't luxury buildings. These are average communities where insurance costs for the master policy skyrocketed 20 to 40% in a single year. The HOA had no choice but to pass that cost directly to owners. And here's the psychological torture. Annual increases of 2 to 5% are considered completely normal and necessary to keep pace with inflation, which means your HOA fee will never stay the same. It will always go up. Always. Communities that don't implement regular, modest increases face larger jumps later or defer maintenance that damages property values. So you're trapped between steady bleeding and catastrophic hemorrhaging. But wait, there's more. Beyond regular fees, you face special assessments. These are one-time charges distributed among all unit owners for unexpected building repairs or improvements. They can drop a $10,000, $20,000, sometimes $50,000 bill in your lap with 30 days notice, no vote, no discussion. Just pay up or lose your home. You think you own your property? Try not paying that assessment and see who really owns it. Let me paint you a picture of how these costs actually stack in the real world. Take a mid-range condo in a major city. Your monthly mortgage on a $450,000 unit might be $2,200. Add $400 in property taxes, add $350 in HOA fees, add $150 for insurance. You're at $3,100 before utilities, before maintenance reserves, before parking fees, or any other nickel and dime charges the building dreams up. And all those numbers, except your mortgage payment, are rising faster than your income. Florida condos are the canary in the coal mine here. In parts of South Florida, HOA fees now range from $1,000 to $2,000 per month, not per year, per month. Combined with rising insurance premiums, property taxes, and mortgage interest rates, monthly costs for a mid-range unit can easily hit $4,000 to $6,000. Meanwhile, a comparable one-bedroom in a luxury rental building leases for $1,600 a month. Renting is 40 to 50% cheaper than owning. You save thousands annually while avoiding property taxes, HOA fees, and maintenance responsibilities entirely. The math has inverted. Ownership has become the expensive option. This isn't theoretical. Indian River County data shows single-family home sales up 12.9% year-to-date, while condo sales plunged 17.8%. Cash buyers dominate what transactions still happen. Out of 176 condo closings in the first quarter of 2025, 133 were all cash deals. Finance buyers can't make the numbers work anymore. Only people with liquid capital can absorb these cost structures without drowning. The budgeting rules you've heard are lies. Financial experts say set aside 1 to 4% of your home's value annually for maintenance. For a $200,000 home, that's $2,000 to $8,000 per year. Sounds reasonable until you actually track your spending. One homeowner budgeted 1% of their purchase price, $4,800 annually. They've spent closer to 2 to 3% every single year, $10,000 to $15,000. The guidelines don't account for reality. They don't account for the water heater failing the same month the roof needs repair. They don't account for the HVAC dying during a heat wave when contractors charge emergency rates. The average homeowner spent $3,018 on maintenance and $2,321 on emergency repairs in recent surveys. That's $5,339 combined, but homes built before 1960 cost 8% of home value to maintain annually. If you bought a charming older home for $300,000, you're looking at $24,000 per year in maintenance. The character and history come with a price tag that'll bankrupt you. Here's what nobody tells you when you're signing closing documents. Your house isn't an asset. It's a liability with an appreciation kicker. Assets put money in your pocket. Liabilities take money out. And right now, between maintenance, taxes, insurance, and fees, your house is extracting wealth faster than it's building equity. A 2024 survey found 87% of homeowners experienced a home issue requiring a professional in the past year. Over 33% couldn't cover an emergency repair over $1,000. 15% couldn't swing one over $500. More than 1 in 3 homeowners panic when something breaks because of the associated expenses. Nearly half say stress from mandatory repairs has increased since the start of 2025. More than 60% are more worried now about covering maintenance costs than they were just months ago. This isn't a poverty problem, this is a homeownership problem. The system sold you the dream. White picket fence, equity building, generational wealth. What they didn't mention was the part where you become a full-time project manager for a money incinerating machine that breaks on schedule. The HVAC dies during a heat wave. The water heater floods your basement on Thanksgiving. The roof develops a leak during the one storm. Your insurance declares an act of God. 44% of homeowners experience their first surprise repair within the first year after closing. 12% face one in the first month. You haven't even finished unpacking and you're already hemorrhaging cash. Foundation repairs range from $2,200 to $8,100 for basic fixes. Full lifting or leveling can hit $30,000. Replacing a 1,200 square foot roof averages $5,700 to $12,000, with most homeowners spending around $8,400. But in 2025, higher material costs and labor shortages are driving those numbers even higher. A new HVAC system runs $7,000 to $15,000, not including ductwork repair, electrical updates, or system upgrades to meet current efficiency standards. Plumbing emergencies cost $120 to $300 per hour during nights and weekends. Roof repairs start at $150 for minor issues and climb to $6,000 plus for extensive water damage. HVAC repairs average $150 to $450, with service call fees ranging from $75 to $200 just for someone to show up. These aren't luxuries, these aren't upgrades, these are systems failing on their biological clock while you scramble to find money you don't have. The average household spends close to $4,000 a year on unexpected repairs. That's the average. If you own an older home, multiply that by 3. So homes built before the 1960s have the highest average annual maintenance costs at 8% of home value. You bought that charming Victorian for $300,000? Congratulations. You're spending $24,000 per year to keep it from collapsing. The character comes with a price tag that makes new construction look like a bargain. Let's talk about the HGTV effect, because this might be the cruelest psychological trick the housing market plays. You watch those shows. The couple buys a fixer-upper, they gut the kitchen, they knock down walls, they install shiplap everywhere for reasons nobody understands. 30 minutes later, the house looks like a magazine spread, and they're high-fiving over champagne. What they don't show you is the part where that kitchen renovation was supposed to cost $15,000 but ended up at $35,000 because they found mold behind the cabinets. the electrical wasn't up to code, and the plumber discovered a pipe that's been slowly leaking for a decade. Year-over-year spending for home renovation and repair is predicted to reach a record $526 billion by the first quarter of 2026. That's not because people love spending money on grout. It's because once you start, you can't stop. You replace the kitchen cabinets and suddenly the appliances look ancient. You replace the appliances and the floor looks terrible. You replace the floor and the living room paint looks dingy. 7 categories of home care saw double-digit increases in repair and maintenance costs from the first quarter of 2024 to the first quarter of 2025. Supply chain issues created material shortages, extreme weather events drove up repair frequency, labor costs exploded, interest rates on home equity loans and credit lines made large renovations more expensive to finance. You're paying more for everything while earning raises that don't keep pace. The typical single-family home costs over $21,000 annually to own and maintain. Homes in New England cost twice as much to maintain and operate as homes in the East-South Central United States. $13,130 versus $6,270, same country, double the cost. Location isn't just about the purchase price, it's about the ongoing extraction rate. And if you think you can escape by buying new construction, think again. Newer homes cost less to maintain as a percentage, sure, 2 to 3% instead of 8%, but newer home prices are significantly higher. You're still writing the same size checks. You've just traded old problems for expensive problems wrapped in modern finishes. So what do you actually do with this information? Because I'm not telling you to never buy a house. I'm telling you to stop treating homeownership like a magic ticket to wealth. It's not. It's a leverage bet on appreciation while you pay rent to the bank, the government, the HOA, and the physical laws of entropy. If those appreciation numbers don't materialize, if the market stays flat, if your neighborhood declines, you've spent years paying a premium to own something that's extracting your wealth instead of building it. Let me show you what happens to your wealth over time with this setup. Let's run the numbers on a typical $400,000 house. You put 20% down, borrowing $320,000 at a realistic 7% interest rate. Your principal and interest payment is $2,130. Add in the taxes, insurance, HOA, and maintenance we just talked about, and your realistic total monthly cost is $3,413. You are spending $40,956 per year just to keep the house standing. Now, look at the opportunity cost. If you had invested that $80,000 down payment in a boring index fund for 30 years at 7%, it grows to $609,000. But the real magic is the monthly difference. Renting a similar spot might cost $2,000. Owning is costing you $3,413. That is a $1,413 monthly difference. If you invested that difference every single month, you would retire with $1.6 million in liquid accessible wealth. The homeowner? They have a house worth maybe $850,000. After paying 6% to sell it, they walk away with $799,000. The renter has $1.6 million. The owner has $799,000, and yet we've been culturally programmed to believe the renter is the fool. The alternative isn't glamorous. Rent the house, invest the difference between ownership costs and rent into actual assets that don't require quarterly gutter cleaning. Max out retirement accounts, build a taxable brokerage, stack cash and high yield savings. When you rent, the roof is someone else's problem. The HVAC is someone else's problem. The special assessment is someone else's problem. You pay one predictable bill per month and you're done. Your money compounds instead of evaporating into contractor invoices. Homeownership isn't evil, it's just expensive, prohibitively expensive for many people who've been told it's the only path to financial security. The real security comes from understanding the full cost structure before you sign, from running the actual numbers instead of trusting the real estate agent's fantasy projections, from recognizing that the American dream has property taxes, insurance premiums, and maintenance schedules attached. Nobody's coming to rescue you when the foundation cracks. The house doesn't care about your budget. It will break. You will pay. The only question is whether you planned for it. So run the math before you fall in love with the granite countertops. Calculate what you'll actually pay per month after taxes, insurance, HOA fees, and realistic maintenance costs. Compare that to rent. Be honest about whether you're buying a home or buying into a story about what homeownership is supposed to mean, because the house will take your money either way, but at least you'll know what you signed up for.